The Federal Reserve is making a series of changes to requirements put in place to prevent a repeat of the 2008 financial crisis. According to the New York Times, the changes could add up to a weakening of banks' ability to withstand financial losses if the economy takes a turn for the worse. At the forefront of these changes are a vice chair of the Fed nominated by President Trump and Federal Reserve Chair Jerome Powell. Jeanna Smialek joins us now. She's the Federal Reserve and money reporter at the New York Times. Jeanna, thanks for being here. What are some of these changes that the Federal Reserve is attempting to make, and what does it really mean for the average person?
Right. So none of these changes are massive individually. What we've seen is a number of sort of little tinkerings with the post-crisis regulatory regime that add up to an overall weakening in bank capital. And so none of this is going to have a huge impact on your everyday American at face value, but when it could really matter is if we should hit another crisis and these banks enter that crisis with lower levels of capital and sort of weaker protections overall, because what we could see is something similar to what we had in the last downturn, which was widespread bank bailouts, instances that really cost the taxpayer a lot of money.
And now in your article, you talk about proposed changes to the Volcker Rule. It's not really a household name, I think, for most people on Main Street. Can you tell us what the significance of the rule is and what the changes could mean?
Right. So the Volcker Rule basically was trying to prevent big banks from doing proprietary trading, which is essentially just a fancy way of saying trading assets and securities to make money for their own books. And so the Volcker Rule has been really sort of defanged in this recent decision by the FDIC and the OCC. This has yet to be approved by the Fed, but people think it most likely will be. Essentially what the Volcker Rule used to do was assume that banks were kind of guilty until proven innocent. So if you were trading short-term securities, you had to prove that you weren't trading for your own book. Now they're flipping that presumption. So now you're kind of innocent until proven guilty, and there were a couple of different countermeasures that had been proposed to replace the guilty until proven innocent tenet of this, and those were just also defanged in this final rule. And so the end result, sort of the upshot of all of this, is that the Volcker Rule is just a much less powerful containment mechanism than it used to be, and that banks kind of won a victory here. They didn't like this, and now it is not nearly as binding as it used to be.
Now, there are certainly some in the Fed that argue the current requirements are too restrictive. So who benefits here by reducing the capital requirements?
Yeah, that is absolutely true. Some people in the Fed will say the current requirements are too restrictive, and even that they have adverse consequences. I think what you see here, though, is that the banks in general, especially the big banks, do benefit from some of these rollbacks. They make it a little bit less, demanding. They make a lot more certainty for these banks, especially when they're approaching their annual stress test cycles. One big change we've seen come down the aisle is that the Fed is being a lot more transparent about what is on these annual stress tests, which are essentially just a health checkup for these big banks. And that is making it a lot easier for banks to anticipate what their capital needs are going to be. Some people say that improves efficiency, and some people, like Neil Kashkari out in the Minneapolis Fed, says that this is a dangerous backsliding that could leave us more vulnerable in the next crisis.
On the other side of this argument, there are Fed officials who worry the changes could leave the economy exposed in a downturn. Is that because banks may not have the capital on hand if things get really bad?
Yeah, absolutely. And so Neil Kashkari, who I just referenced, is sort of, one of the people leading the charge on this. And then Lael Brainerd at the Fed, who's a governor on the Fed board, also very much has sort of dissented against and spoken out against a lot of these changes. And their basic argument is that capital ratios are already a little bit on the low side. So basically the money these banks have to help them weather the storm, that isn't as high as it should be. And if you look at Fed research, research by the Fed board staff says that somewhere between 13 to 26% would be an appropriate capital ratio. Capital ratios now are around 14%, so certainly on the lower end of that range.
Now, President Trump has attacked the Fed and its chair a lot lately. In fact, he's called Jerome Powell an enemy of the people. How much of these decisions is playing politics?
Yes, so it's an interesting question. Certainly, this is something that Randall Quarles, who is Trump's nominee for the vice chair for supervision at the Fed, this is something he has really championed. Jerome Powell has been a little bit more cautious. He's the Fed chair and also a Trump nominee. He's been a little more cautious about this stuff, and he has, while he's been broadly supportive, I think, and hasn't dissented against any of these decisions, has been a little bit sort of more hesitant to approach some of the bigger rollbacks. And so I think that there's probably some amount of politics in here, but some amount of it is just that Randall Quarles was always a bit of a deregulatory proponent, and I think his position on the Fed has really allowed him to sort of push those changes forward.
Jeanna, thank you.
Thank you.